Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, and today we're talking to a man who's built a $50 million property portfolio, in excess of $10 million of that in super, and we have a chat to him about how he actually achieved that and his great tips on how to use your super fund to supercharge your wealth creation journey. We've got Manoj Abichandani from trustee.com.au. He shares some amazing insights on his background moving to Australia, working his way up the ranks as an accountant and self-managed super fund specialist, all the way to the point where he gives advice on how we can avoid paying back the bank and using that surplus cash to fund our lifestyle and building our super fund balance. So in this two-part series, we start with his background and move into some of the more complex sides of his advice. It's a very interesting and eye-opening episode with Manoj, and I'm sure you're going to get something out of it. Here he is. Manoj Abichandani, thanks for joining me on Geared for Growth.
Yeah, thank you, Mike, for inviting me, and it's my pleasure to talk to you, and hopefully some of your listeners will get a couple of hints from this conversation today.
I'm sure they will, because you're pretty much in rarefied air when it comes to your area of specialisation. Of course, the results that you've achieved as well, and they certainly leap off the page or the podcast download. Let's rewind a fair bit though. Let's talk about how you came to the country and kind of what your professional background is and where you got to the point where you could start looking into self-managed super funds.
Yeah. Mike, I came to Australia in 1988, so that's way back. And I'm an accountant from India. Although was born in India, I was working in a country which is south of Africa, Zimbabwe.
Mm-hmm.
So I came from there. I worked there for a couple of years in a TAFE kind of an environment. And there was a shortage of teachers in Australia, and especially the topics which I was teaching, like business maths and auditing in Zimbabwe. So when I came here, it was pretty tough because no TAFE wanted to talk to me. I needed certain experiences and certain local, qualifications and all that.
Mm-hmm.
So it was pretty tough. So I had to wash dishes in a restaurant in Canberra for almost a year.
Oh, wow.
So it was not so easy. So this is just to some of your migrant listeners would probably relate to that it's not very easy to work overseas and come and do the same stuff when you arrive in Australia.
Yeah. I mean, the one thing that I guess we've observed on the podcast, having interviewed a number of migrants, is that exact example as you talk about. You have a certain level of qualification or experience that can be quite a high level that is not duly recognised in Australia, but also the immigrant work ethic is a force of nature, right? So rather than sort of getting upset about your situation, you just
no. I was pretty realistic, and not only that, it was my fault because I come from New Delhi, which is the capital of India,
Mm-hmm.
and when I was coming here, my father told me go and live in the capital city, and I ended up in Canberra. And Canberra is, as you know, and back then I think we had population of only 120,000 people. It's not a very commercial city.
No.
So after a year, one day trip to Sydney, I had a job, so I was then working in my profession. Then put myself through evening school, doing waitressing, and I went to UTS and I converted my degrees because I wanted to go and teach in TAFE, so I had to have a local degree. So I got a bachelor of business in small business in accounting. So it was pretty interesting. But and then I worked for 7 years for various chartered accountants, and sometime in 1995, I set up my own tax practice. And I was very lucky because where I was working in the city, fortunately or unfortunately, I was in those days, self-managed super funds were not that popular. We had only about 140,000 super funds, and the most of the legislation changed in 1994. So I worked in the previous legislation where anybody could be a trustee of a self-managed super fund. So we used to have one entity managing many, many super funds. So I had
Mhm.
that just that luck that I was working for this firm, and they were very, I should say, known to be good in self-managed super fund. So they were not like today we have administrators who manage over 1,000 funds, but they were looking after a couple of hundred funds, which was a huge number, and they had a
Mm.
department separately. We never had very good softwares, which we have today. Yeah, but it was pretty interesting. And then when I set up my own practice, I would, because that's what I knew the most, I
Mhm.
started operating in self-managed super funds. I used to go and give talks on Money Show, and then when 2007 came, there were a lot of changes made to superannuation legislation, especially as to borrowing is concerned. And that was the time when Telstra was, the second tranche of Telstra was being sold.
Yep.
And I don't know whether you remember, the government wanted money, and we were going into GFC kind of a situation. So the only people who had money who would buy the Telstra in 2005 and 6, I'm talking about, that's when the legislations were being drafted. So they encouraged super funds to buy, but then super funds didn't have enough money, so they allowed super funds to borrow. So if super funds could borrow, they could buy the Telstra shares, and the government was very keen to offload it, and
So
they
was
called it.
that? Sorry, Manoj. So that was, you would say that was the main motivation for the relaxation of the borrowing rules in
Uh,
self-managed super funds, was part of that the
yeah,
Telstra float?
the that was they called it installment warrants back then, and
Right.
then yeah, and it was section 67(4)(a), which was introduced back then.
Mhm.
And the whole purpose, the government had that big, don't ask me what number it was, but it was a huge number they wanted to offload,
Mhm.
and the market wasn't ready because we were getting ready for, slowdown, and we all know what happened in 2008.
Yeah.
So the whole GFC, crumpled. Money was very difficult to find. But there was some lending. So they were actually, had they introduced it in 2009, I doubt it would have been that popular. Maybe, not that popular at all, because there was no money by 2009. But by
Mm.
2007, it was, and was not very popular in the beginning. The interest rates were very high. The banks were, still trying to understand, because the super fund trustee was one, but it could not own the asset. The asset was to be held by another entity.
Yep.
So they were they were lending to this entity, whereas the asset was held with this entity. So they did not understand, and there were some law firms which came in, which simplified things for the banks, and the banks like Westpac, CBA came up with a product as well. As everyone knows, none of the big banks are now in the picture.
Mm.
So yeah, it was quite um, difficult at the moment, and then the interest rates were not there, and then things moved on, and not many people had money in super. We're talking about days, In 2007, maybe we had 300 to 400,000 super funds. By the way,
Yep.
now we have about 625,000 super funds.
Oh, wow.
And another factor was that compulsory super, the employer super, was very low at that time. We're talking
Yes.
about 4 or 5% contributions, and now it's 11.5. So, a family earning 150,000, they are getting 15,000 pumped into super every year by their employers.
Mm. And
So everyone has money in super now.
yeah, and where are we at with the state of play with lending at the moment? Obviously, we
Yeah.
can get LVRs, I think, around 70%. As you mentioned, there are some banks that are the big banks that aren't really playing in that space. We still
Yeah.
can't kind of borrow
Yeah.
against the property in the self-managed super fund. Do
Yeah.
you see that as a state of flux at the moment, or is it pretty static? Do we expect that to
Um,
change?
Look, there is a way where you can involve the big banks. And I do not recommend that you borrow from second tier lenders, and there are quite a few of them like Latro, Granite, and there are many others. They're the second tier lenders who would lend directly to your super fund.
Mhm.
There is another, which I never borrowed from with my super fund from outsiders. I always lent the money myself to my super fund. So
Right.
that's
Okay.
very easy. That's very easy to do, because if you have money, you can lend to your super fund. Anybody can lend to the super fund, can borrow from anyone,
Yep.
literally. So if you have a company that's got some money, if you have a discretionary trust or a bucket company or whatever, so that entity can, and it's controlled by what percentage you can charge. It must be at market value. The super fund must pay you on a regular basis. So you have to mimic a bank,
Right.
basically, when you lend to your super fund.
So
So, yeah, sorry, yeah,
no, I was just going to say, so with your setup, I'm interested in the sort of the structure that you set up. So you obviously
yeah,
had your accounting practice. So
yeah,
was that a matter of the company is lending money to the super fund at kind of market rates, and
yeah,
that
yeah, yeah,
there's a contract in place, even though they're
yeah.
related entities, it's
Well,
very separate.
there's a proper loan document and there's a proper mortgage. You're
Yep.
just mimicking the bank, basically.
Yep.
You do the same thing. But I must tell everyone who's listening that if you want to be successful in property, like, I was counting the other day, it's very difficult. But now, since I'm over 60, I maintain a password protected spreadsheet because when you turn 60, anything can happen to you. And usually it happens, not only in the Indian culture, but when I was in practice, I was looking after 600 super funds. It's usually in a family environment, one person is more dominant than the other, and the other person doesn't know what is happening. So
Yep.
mostly it's the male who drive it, but it can be the females as well in a
Mm.
in a family, in a husband wife situation. So now I keep assets and liabilities with a password. So if anything happens to me, if I don't wake up one morning, my wife and children know the password and they can log in and see what's happening. Yeah, but
Yep.
what I wanted to tell everyone is that, and most people who I talk to, they work Monday to Friday,
Hmm.
and they want to do this on the weekend, So it's very, very important that if you want to build intergenerational wealth, not like buy two, three properties, and I think the numbers are very low when you see people who have five or six properties.
Hmm.
I think there are only 15,000 people in
Yeah.
Australia or something like
Yeah.
that
Yeah.
who
There or
have six
thereabouts.
properties. Yeah, yeah. And there are very few number. I think 70% of people have only one investment property.
Mm.
And if you go into two, it's like, number dwindles. Once you reach three or four properties, very few people have that number of properties. And then you engage buyers agents and things like that because you're working.
Yes.
So my benefit was, because I was self-employed, I could choose which day I'm not going to work and I'm going to do this.
Hmm.
And slowly, today I'm at home, but slowly and slowly it was one day a week, 2 days a week. and 3 days a week, and sometimes it's even 4 days a week. I like my inbox gets about daily about 10 to 15 proposals.
Mm-hmm.
And I'll talk about what type of proposals. It's the real estate agents. I'm in their database. They send me deals.
Yep.
So it's not. It takes time. 5 minutes to hit the delete button, but it's not a part-time thing. Wealth creation is
Mm.
like a full-time job, and to do that job, you have to be very diligent. And if you want to you have to read a lot of books. You can't do it on Saturday, Sunday. You have to it's income. You have to worry about how you're going to generate that income.
Yep.
um, and the worst thing I will ever recommend anybody is negative gearing, and that fundamentally is so wrong that it stops you from buying the second and the third property,
Mm-hmm.
and the fourth property. Because if you look at it, I can explain you with a very easy example. Let's say if your income is 100, it can be 100,000 or 200, but just say 100,000, right? And you lose 10. Right,
Mm-hmm.
so you're left with 90 because you've lost 10 for that investment property. And because you lost 10, the government may give you 30% as refund, right? So
Mm-hmm.
you end up with 93. Now, if you replace that and change it into positive gearing, so you go back to that same equation and you say that I have 100, but you get 10. So, there is an income, there's a
Yep.
positive, right? So you gain 10. And on that 10, you might lose $3 in tax because you have to pay tax, right?
Mm-hmm.
So you have to keep your income high. So 100 plus 10 is 110 minus 3, you end up with 107.
Mm-hmm.
Now, one guy's got 107 and the other guy is losing in 93. So you'll never be rich with 93. You'll always be richer than 107.
Yep.
So those people who are doing negative gearing, please, you don't know what you're doing. So you really need to go and talk to some accountant or financial planner who you can understand, because sometimes financial planners speak in a lingo which you don't understand,
Mm.
and there are a lot of accountants, by the way, they're only about 10 to 15% of accountants who understand self-managed super funds. 85% will talk you into it, but they can't give you strategies. It's not about number counting, it's not about bean counting, it's about strategies. That's what self-managed super fund is about.
Just in playing devil's advocate, you could say, well, there's two ways we're talking about negative gearing potentially. One is within a self-managed super fund, which is different to, say, an individual, right? But people might say, okay, well, I'm quite happy to take that loss if my capital growth prospects are, twice
Yeah.
as good as, say, a cash flow property. So
Yeah.
yeah, we might have less serviceability from a bank point of view, but we will potentially have higher equity growth in the property, and we can kind of leapfrog from there. What would you say to that?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Look, that's itself is fundamentally wrong, and I'll explain you in a different way. You see, and I've heard this argument for so many years that you will have six properties, you will sell three, and then you'll have three fully paid up.
Mm-hmm.
You'll release three, and then the loan after the growth, and then three will pay you rent forever, right? But if three will pay you rent forever, let's say nowadays rent of $1,000 is very common on any property, so each one will give you 50,000 rental income, so you'll have 150,000 60,000 rental income. Now, all those three properties can very easily be in self-managed super fund. You with me?
Yep.
So what happens is once you're over 60, you don't need to work. If you're getting 150,000, you might as well chuck your job in, and you can pursue your passion, you can do other things. And then 150,000, because you can start a pension in your self-managed super fund. And if you are two, husband and wife, you can have $1.9 million each in pension phase, which is retirement phase, which doesn't pay tax on income.
Yep.
And if you're over 60, you can withdraw that money. So, we are talking about the structure. That's very important. Why buy properties in your name or in trust name, And then if people talk about land tax, you self-managed super fund also uh, gets a land tax threshold. If you want, you can have two self-managed super funds, so you can have two properties here and two properties there. But what is very important, and I wanted to pick your brain on this one, is that a lot of people are not able to contribute to their super. And the reason they are not able to contribute to their super is because there is no money.
Yep.
All the money is going into paying off your home loan. Yeah.
Yep.
And the other day, I was talking to one of my staff members who bought a house about 4 years back, and in 2020, we were just coming off and he bought a house in the Hills area in Sydney for 1.2 million. Now it's worth about 1.8 million. So his loan, when he bought it, it was 1.1 the loan, but over 4 years, he's been able to reduce the loan with 4 years of payment. His loan is about 1 million, but the value of the property has gone up to 1.8 million. So what I was trying to tell him is that he's paying about $6,700 per month in repayments, which is, people can work it out what the interest rate is. But the interesting part is that to pay that 6,700 per month, if you work it backwards with 34% tax rate, even the tax rates have reduced now from 1st of July 24, he has to earn almost 9,500, pay the tax, and then pay the bank 6,700. And he's 37 years old, and he's going to continue to do that till another 15 years. So from 37 to, he's already old.
Yep.
He'll just continue paying. And what's happening to his super? It's only his employer. He's on a very good salary. His employer is paying maybe $15,000 into his super, but that's
Yep.
it. That's all he will get. He will, by the time he retires, depending on how his super is going, he might end up with only $500,000. Maybe he's 60, 65. If he loses his job, then he's on Centrelink, and that's the problem in this country. You don't have the money because you're paying your money to the bank. You're not keeping it for yourself. You're not keeping it for your retirement. Yeah. So the idea is, do not pay back the bank. I still have a loan. I'm 61 years old. I still have my home loan. I haven't paid a cent back. I don't pay them principal. I don't pay them interest. I pay them nothing. And that's very easily possible. And I'll explain you how. So,
Please,
yeah. So he's got 1.8 million. He can easily go to the bank and say, okay, I've got a loan, but they'll always keep 400,000 as equity because 1.8, 20%, they want that. So let's just call it 400,000. But his loan at the moment is 1 million. But he's got 400,000, which he can take a line of credit or a second loan.
Yep.
So what happens is, he doesn't have to pay the 1 million from his pocket, from his earnings. He pays the 6,700 every month from the second loan.
Right.
Okay. And I sat down and I worked it out with him that $400,000 will last him about 6.5 years.
Right.
So for 6.5 years, every month he'll have $9,500 for him to enjoy life. Because believe me, at 61, I could be worth 50 million. I cannot enjoy life as much as I can with someone who's 37. And the reason being is my kids have left home. They're not, they've got their kids, they
Yeah.
got their own kids,
Yeah.
So I can't take them anywhere. I can't. She's got a job. My kids have, are busy.
Yep.
So I cannot take my wife to Europe at the moment because now we are looking after grandkids. So when
Yeah.
when you reach older, the need for money reduces.
Mhm.
So for 9,500, what he can do is put half the money into super, and the remainder half he can buy his children Nike shoes worth $250, which he can't afford.
Mhm.
So having a good life at the right age is very, very, very important.
Mm.
So having these two loans, and then what's going to happen after say 6.5 years, his valuation. Now we know Sydney, we know the shortage of supply, and I know for the last 30 years. Now it's very difficult to say what if the value stops growing,
Mhm.
and then he has, instead of a 1 million loan, he has a $1.4 million loan. That's
Yep.
possible. But then history has shown us, and I think I've seen data since 1960, the valuations have always been steady. Some years we have had down, but it's always been on the growth.
Mm.
And the common sense is that if we have inflation like we do, that $1.8 million house, the cost of the brick will go up by minimum 3%. That's not what I'm saying. Between 2 and 3%, that's what the Reserve Bank is saying. So it'll
Yes.
always grow at that rate of inflation. And there's a shortage. The councils haven't been very active in
Mm.
mobilizing the outskirts,
Yeah.
although where West is growing. So there'll always be shortage of land. So what you need to do is you need to pump in your super, and then with your super, if you can't lend it, borrow. Your super fund can borrow, and you'll have two horses. So you said your valuation will be going up. Yes, your valuation would be going up, but not only on your own home, but on the investment property, but in super. Because the beauty about super is that it's the only structure which I know when you die, and this is something very few people may know about. Okay, let's just go back to your situation. You buy six properties, and then once you're retired, you sell three, you're left with three. Okay,
Mhm.
and you enjoy the income from the three. Now you're ready to die. Now everyone's going to die, right? So what happens to these properties? And if you have two kids, most likely you can't divide three properties in two kids. So
Mm.
most likely all these three properties would be sold.
Mhm.
And when they are sold, the cost base of these investment properties would be used to work out the capital gain tax when your kids sell the property.
Yep.
Right now, in a self-managed super fund, if you had three investment properties, you can add your kids into your self-managed super funds,
Mhm.
so they can inherit these properties which you bought without paying any what do you call stamp duty,
Yep.
or acquire these properties from you
Yep.
and pay tax on it, and they can continue holding these properties forever and ever. You
Mm.
know what I mean? And
Yeah.
when they sell, your kids, when they sell, they could be in pension phase.
Mhm.
And when they're in pension phase, again, they are not going to pay any tax when they sell the properties.
Mm. Yeah.
So, as far as transfer of wealth, state planning, and intergenerational wealth is concerned, there is no better product. And now, although the tax office doesn't think that reduction of tax is the purpose of super, the sole purpose tax, which is Section 62, always talks about, the purpose of super is to give you retirement benefits. When you retire, it should give you income. So,
Yep.
that's the third pillar. It's not only you working, Centrelink providing, but for self-funded, self-managed super fund provides you all the income which you will need in your retirement.
Yes.
But you see, this is just in a nutshell. You have to read every book out there, go and talk to every accountant, and then get the right advice. Because the first question you should ask the accountant is, do you have a self-managed super fund? How many
Yep.
properties do you have in your self-managed super fund?
Yep.
Because if the accountant doesn't know how it is done for himself, he has no chance of telling you on how it can be done. So that's the crux of it,
Yeah.
And if you join an accounting firm as a client, you have to ask them, how many do you have? At least 100 super funds. So anybody has less than 100 super funds, he cannot be your accountant.
You're right.
Yeah. And then how many of them have property? So that's very, very important,
So
And then keep income high, because your income is all, you had no negative gearing in your own fund. All you're doing is salary sacrificing, pumping money into super, and your super fund borrowing and buying assets. And you see, if you buy a low income asset, it's not, forget the growth. You don't want growth, believe me. And there's always a problem with growth. It can be any value. So let's say I have these three properties. They could be $1 million each or $2 million each, right? It doesn't matter, because I'm not going to sell, right?
Yep.
What depends is how much income is the first one giving me, how much income is the second one giving me, and how much income the third one is giving me. Because I need that money to live on,
Yep.
right? When I'm retired. So high income should be your key. Whether it grows or not, it doesn't matter.
So when we
And that means staying away from residential properties.
All right, well, there's a lot to unpack there, but we'll take this opportunity to wrap up episode 1 of this 2-part series. I'm very much looking forward to deep diving further in episode 2. So we will see you next week.